I think you could see both silver go crazy and move in a way similar to what it did in prior cycles. And I think we're likely to see oil do the same. And I'm a huge metals fan as an oil bull because the higher the metals go, the more likely it is that we end up with substantial incremental mining related demand. The fundamental case and the technical case, I think, for silver and for oil and certain other commodities looks great here, and the supply-demand balances for oil, due to the underinvestment over a long time, look extremely compelling here.
Josh Young, Chief Investment Officer of Bison Interests. It's a true pleasure to host you on Palisades Gold Radio today.
Thanks for having me.
Excellent. Really excited for this one, George. We're going to be talking about oil and gas extensively, broader commodity complex as well as gold, precious metals. But before that, I would love to dive into the bull case for oil and gas, and specifically what is behind yours.
Yeah, sure. So I posted on social media recently this cartoon which shows this long line of people who were interested in buying oil at $120 a barrel like we saw in 2022, and no one in line to buy oil at $60 or $65 a barrel like we've seen recently. And so, if you want to try to find people who are bearish on oil, it's easy. Just turn on TV, go on CNBC or Bloomberg, or listen to almost any podcast interview. I mean, people are just massively bearish. And the reason to mention that is that it's really comfortable to be bullish, and I understand that anyone listening to this is going to be cynical hearing, oh, there's an oil bull, that's ridiculous, and have some prior concepts in terms of what's happening in the market. But I think it's important to anyone listening and in formulating a thesis to understand sort of what the likely market structure is like, because there's always a buyer and seller setting a price at any given price that you're seeing in the market. And so the starting point here is extremely fun for me and way more comfortable than it was when oil was 120, because you have all these people that were long oil, that were bullish, who are bearish, and there's very many things that people are worried about in terms of potential oil glut and OPEC bringing barrels onto the market and US shale production looking pretty high versus expectations. There's many things that people are going to think of right away when they think of oil. And the reality is that all of that information is not just known, it's extremely well broadcast, and it's a deep financial market in which it's likely priced in. So I think just as a very, very high level, basically any bearish information or perspective on oil is already very broadcast and probably already priced in. And so as just a base starting point, knowing that gets me very excited. And, it's almost the whole thesis. I mean, there's lots of stuff and nuances in terms of various things that are happening in the market. But when everyone's obsessed with a potential glut, when everyone's bearish and negative, and where it's really hard to find any cogent answer in terms of why someone should buy oil, that's a very exciting point, I think, to want to own something, particularly a commodity which over the long run has shown itself to be substantially mean reverting.
Point well noted. Be a contrarian when everyone's bullish oil. Maybe don't be bullish when everyone is bearish oil. Perhaps it's a great time to be bullish on that commodity. I would love to dive into some fundamental drivers through which one can be bullish on the energy complex as well. I believe one of them is underinvestment in that sector. Perhaps this will come up when we make parallels with the commodity complex as a whole as well. But perhaps you can dive into that for a second, really, how that is driving the thesis.
Yeah, sure. So I've been bullish oil for probably too long, and the thing that got me bullish from sort of like a short-term market dynamic perspective, the thing that got me bullish was seeing the collapse in exploration and delineation investment and activity in oil, where you had that activity sort of start to peak out in 2011, 2012, and sort of really fall off a cliff in 2014. And so when I think about the potential significant oil bull market that we're getting into, as well as looking back at prior oil bull markets and other commodity bull markets, it's nice to sort of look at those sorts of fall-offs in exploration and sort of start like a stopwatch, essentially. Start the timer for, hey, here's where you know that you're not at the peak anymore. And knowing that you're not at the peak is actually, I think, most of the battle, because if you're at the peak, you can have this sort of calamitous collapse. But once you're past that, you're just time is your friend, because insufficient exploration leads to insufficient delineation, which eventually leads to lower well productivity and disappointing production results and sort of negative surprises from a production perspective. And what all that means is that supply becomes more expensive and it becomes more scarce, and eventually that compounds to the point, and again, it's very hard to predict exactly when that will happen, but you sort of know, I think, the direction, and you have an idea on sort of the potential order of magnitude. And so getting the direction and the order of magnitude right, I think, matters the most. And in my approach, basically, I say, okay, so investment activity is way down, the dollar amount's down, but also the drilling activity is substantially down, the delineation activity is down, and proved reserves and sort of identified reserves globally have fallen substantially in countries where they actually deduct the production from the reserves. So there's also a bunch of countries that claim large reserves, but they've magically had the same reserves without exploration over decades. So anyone that's honest, the honest accounting for reserves is that it's fallen. And as a base setup for a commodity, particularly for oil, where you extract oil and then you burn it or refine it and it's gone, unlike many other commodities where you mine them and then you just have it for essentially forever. So because of that nature, there is this extreme mean reversion in oil price over time to make up for over or underinvestment. And so I think we have this just beautiful, very long run underinvestment. And the different manifestations of that are debatable, and the timing of it is always an open question. But there is this just sort of base fact of insufficient exploration. And so then in the end, what I think you're going to get is, just like with what we're seeing in other commodities, you're going to end up with an all-time high price and surprise and shortages and whatever other sort of like hand-wavy stuff, but it just comes from this underinvestment, and it's sort of the instant success after decade or whatever hard work sort of thing. So similar dynamic for commodities, where you have that base underinvestment, and then eventually there's some sort of catalyst where you end up with a much higher price, and potentially that price being reset higher and sticky for some long period of time.
Today's episode of Palisades Gold Radio is proudly brought to you by our parent company, Palisades Goldcorp, Canada's leading junior resource investment vehicle, trading on the Toronto Venture Exchange under ticker symbol PALI. With equity and warrant positions in over 200 companies, ownership of mineral projects and royalties, and a 15% stake in newfound gold, Palisades offers investors powerful leveraged exposure to precious metals, uranium, copper, and other critical minerals. Palisades shareholders directly benefit from our team's extensive industry knowledge and access to deal flow, opportunities historically reserved for a small group of investors. To learn more, visit us at palisades.ca and join us in our mission to level the playing field for investors. Now, back to the show. Thank you for laying that out, Josh. I'm really trying to quantify that underinvestment in the space, and perhaps I'm catching you a bit off guard here. But how much have those resources dwindled, and how long has this underinvestment been going on?
Yeah, so I'd have to go back through. I probably should have pulled the exact numbers of like drill ships that were active and now have come off. And it's a little complicated. So in dollar amounts, it's complicated because there's been so much inflation in certain categories and then falling costs in other categories. So your day rate for a drill ship is lower now than it was a decade ago, but your hourly wage for your workers is higher, and then your steel pipe is a lot more expensive, and various other inputs are more expensive, but your fuel is cheaper, and so it's sort of, there's a little bit of a mess in terms of looking at it from a dollars spent, and then there is sort of faster activity, so you drill more feet per day now by a lot, both offshore and onshore. So in terms of the dollars, the spend is down, but people will rightly point out that's murky. And I think it's sort of helpful to track, but it's not a perfect number. And again, the reason to not go into the specifics also is, okay, hey, so are we down from $1 trillion to 500 billion? Okay, maybe, but where exactly are you going to account for that? And so I think it's more of a question of order of magnitude than specifics. But let's say, peak, you were close to $1 trillion. It might have been 900 billion, something like that, in that sort of 2012 to 2014 timeframe annually. And now you're maybe closer to that 500 billion or so. And then when you look at pure exploration expenditure, expenditures. They're a tiny fraction of that. Another way that we looked at it at Bison a few years ago, and we put out a white paper on this that was not well received, which was actually exciting because I think people didn't understand how important it is. When you look at the capital expenditures by oil field services companies, right? So not the companies that are funding the drilling, but the companies that are providing the equipment and the technology and the chemicals and the fluids and all the stuff for it. The capital expenditure for the oil field services companies had collapsed as well. And it was closer, depending on how you counted it, whether it's sort of growth CapEx or maintenance CapEx, it was close to a 50 to 80% decline. Again, like much more precipitous than the decline in the upstream exploration and delineation, and also just sort of total upstream capital expenditures. And so that's another way. And again, quantifying it, there are specific numbers, but the problem is the specific numbers often have some debate over, hey, should you have included this particular line item or not? And that's sort of where I'd rather sort of use that range. And so that was very interesting. And it's not surprising because no one's building new drill ships. So of course the capital expenditure is going to be down. But it's not just that. People are actively retiring drill ships. They're actively retiring land rigs. There's a lot less pressure pumping horsepower now onshore North America than there was 2 years ago, as companies have allowed some of their equipment to get chewed through and then discarded, rather than sort of spending the money to maintain the pumps and horsepower and so on. So directionally, those are some of the answers. And then in terms of supply and potential sort of where this is getting get into supply and demand balances, again, there's also sort of these challenges on math and where you want to go. But if you look at the base supply level right now of, let's say, and again, do you count the what do you call it? Do you count some of these refined products that come out and then get stuck back into like the condensate equivalents and naphtha's equivalents or not? But let's say you're at 104, 105 million barrels a day of production. Do you get to the 110 that I think you need over the next few years without oil being way over $100 a barrel? And if you can't, and if you have demand, which is a whole other topic, but demand is basically straight lined at 1% a year growth for the last 40 years. If demand doesn't fall off a cliff, which it hasn't, even with all of this electric vehicle adoption and these other issues, if you have that 1% annual growth, you really struggle to get the supply that you need to get to that extra few million barrels a day of production without much higher prices. And then even when you get those higher prices, it's not clear how quickly you can bring on that production. And that sort of time lag, we're seeing this now in some of these other commodities where if you need it right now, the right price might actually be 3 or 4 times what you would have thought the 10-year price would need to be for that supply if you need it tomorrow or in a year or something like that. So anyway, that's sort of getting into some of the more specific numbers. And again, there's just so many of these nuances, gotchas. Oh, like you left out this thing of 500,000 barrels a day. Okay, cool, that's fine. But really what you care about, I think, is the direction and the order of magnitude. And I mean, some of these things are quite significant. And then I guess just the one other topic on that would be that there were these very large capital projects that got started in the prior commodity cycle and are finally coming online. So we have the second project in Kazakhstan, which came on late last year. And so you have these two essentially giant, one of the projects I think cost close to $100 billion all in. It was supposed to cost 20. And so you have these big projects that kicked off. In one case, I think it got kicked off before the financial crisis. So like 2006 or 2007, they started drilling this thing. And so, yeah, they did spend this money and now they have it and there's production. But Kazakhstan looks like it's already going into decline and they haven't started the next project that's like that. And so when you think about this exploration and delineation challenge and development challenge, you don't really have the answer for almost a decade. You have almost this like lost decade of activity. Yet you have Guyana, but Guyana kicked off, let's say in 2014, 2015, where's the next Guyana and the one after? And yeah, you have offshore Namibia, maybe down into South Africa. But again, you sort of have like, okay, so you have one answer there for 1 year, and you have one answer in offshore Namibia, South Africa, and maybe you have one answer, maybe depending on sort of if you squint, offshore Brazil with an extra 1 million barrels a day, maybe. And then what? And so you have many, many years of deficit in terms of this base activity to get to the supply that's necessary, and you have inexorable declines. There's some debate: are you at a 6% base decline globally for oil, or 12%, or somewhere in there? And the reality is, even if you use those very low numbers at like 6%, even though shale wells, which are now a big portion of a supply, are way higher decline. Even at that 6%, you still need essentially a Guyana discovery a year for a giant block like Starbuck. And it's just not there. So, we're going to see a lot higher prices eventually. And so when you see that, and then you see what's happening with some of these other commodities, to me, it's very exciting because I can wait patiently and own things for the most part that will do very well over time, even if oil prices stay low, that will eventually have sort of bonanza type payoffs. That I've actually, like, for Bison that we've experienced. I have this like Barron's picture in the background where we were up like 1,000% in 18 months or whatever, and everyone's like, "Oh, it's luck." It's like, well, yeah, sure. Like, you just work hard and figure it out, and then own the things and sit there for years, and then you get your 1,000%. So, and not that past performance is indicative or whatever, but I think these commodity cycles do seem to play out in very similar ways.
And of course, the great thing about the oil sector is that oftentimes these companies pay you to wait in a form of dividends, so you can just sit on your hands until the next bull cycle comes in. Talking about shale oil a bit longer for a second, I think that's something we should double tap on. You started hinting at this, the declines of shale oil, but also they require significantly more drilling capacity, right? So if you have less drilling capacity globally, and shale oil requires way more, even though it can drive enormous amounts of barrels a day, those oil fields don't really seem to sustain themselves.
Yeah, I think there's actually quite a bit of debate right now about if we're in decline on crude oil production in the U.S. So some data sources are showing that we are, including some of the pressure pumpers, sort of uncharacteristically. They're a major service provider, but they're typically not in the oil production forecasting world. They're typically not active there, but one of the senior executives of one of the most active pressure pumpers that's best known has been like DMing me and like posting stuff on Twitter or X about how he thinks oil production's in decline, right? So he's literally, his equipment is being used for this, and he says, here's the math, and the EIA is wrong. And then similar, the subsurface experts at TGS and certain other groups, like very deep technical expertise with no reason to get into the oil forecasting game. They just think the numbers are wrong that they're seeing, and they're providing the numbers they see that they think are right. And then, so that's one side. And then on the other side of the debate, you have all the expert consultants that sell this stuff. You have the EIA, which has been sort of politically motivated in different ways. The person that runs it is generally a political appointee, and that's had to revise twice their definitions for crude oil and production, and they keep having these computer issues where their production turns off or their reports turn off for 2 weeks, and then magically you get a glut. And so I'll try to take my tinfoil hat off, but there you have these sort of this debate. And the reason that I feel comfortable even commenting on this is that I sort of don't care. Like, I can see the long run trajectory for well productivity on a per foot basis, which is down. And so in that scenario, basically the second derivative is well productivity. When well productivity falls on a per foot basis, you know that you're in decline. And you may not see it yet on an absolute basis, but you're already there on a productivity basis. And as productivity rolls over, eventually you get into production rolling over. Not too different from having a giant oil reservoir, a giant oil field, and you drill 3 wells and they're great, and then you drill 3 wells and they're mediocre, and then really you're supposed to stop drilling, because if you overcapitalize a field, you can actually destroy your recovery rate, and you can sort of increase your costs unnecessarily, and you're just wasting money. And so in that sort of circumstance, falling production on a per well basis tells you also that you've sort of been overcapitalizing and that you're gonna have a production issue. So there's a lot of debate right now. And again, I lean towards the TGSs and, pressure pumpers forecasting these things just because they're so close to it and they're not using these sort of complicated forecasting models. And they also don't have the politics of it. They're not in it for, hey, is the gas price during midterms going to be 20 cents higher or lower? They're in it for, hey, we just think these things are wrong and it's annoying seeing people publishing wrong numbers and everyone relying on it. So I think I'm with them, but I'm okay even if the EIA ends up being right and we've seen an additional increase in production that's very likely short term. I say that because I can track the well productivity and it's been falling, and therefore, it just seems like a matter of time. So it's sort of a fun debate to observe. It's one of the big questions, I think, in the global oil supply demand picture. And the reality is it sort of doesn't matter other than for very short-term oil prices.
Well understood. Talking about demand for a second, what are you seeing on that front?
So demand has been so interesting. The very simple, again, sort of get back into social media, and maybe I spend too much time on this, but it's been so helpful in terms of figuring out sort of like where the market is and where the sort of psychology around market positioning is. But there's this meme, sort of a cartoon, where they show a brilliant person and someone who's very, very unintelligent, and then they have like a bar chart, a normal distribution, and there's sort of the like person who thinks they're smart but they're not so smart in the middle. And so the dumb person and the brilliant person look at the 40-year trend of demand growth at 1% a year, even with all these narratives and all this stuff, and say, oil demand grows by about 1% a year, pretty much other than a deep recession. And then you have the person in the middle saying, electric vehicles and alternative energy and, whatever other sort of narratives there are around oil demand falling. And one day, maybe in the distant future, we'll see oil demand not rise by 1% a year absent a significant recession or so on. Maybe in the future we'll see that. But until there's overwhelming evidence of that, I would err towards this sort of 1% annual demand growth. And then, when we've seen it deviate so far, it's either been because governments have shut down their whole economies due to the pandemic, or in China we saw some lockdowns after the pandemic was mostly over, which were sort of maybe let's say just call them political in terms of the lockdowns. And so outside of that, we've really just seen this demand growth. Will it all be gasoline demand growth? Probably not, right? As you shift over towards more electric vehicles, whether they're more efficient or not, or cleaner or not, sort of doesn't matter. As you've seen more electric vehicle adoption, you've seen more jet fuel consumption, you've seen more plastics consumption, and even with the increase in consumption of certain natural gas products for plastics, you've still seen increased use of hydrocarbons on the oil side and sort of the liquids complex for those plastics as well. So demand has been growing, and actually there is a case that there were a couple years or actually a few years of below 1% because of the pandemic and lockdowns and so on. And there's actually a case that you could get a catch up, because in the past, like during the financial crisis, there were about 2 years where you were below trend and then you got above trend demand as a sort of catch up. And so there may be a couple of years where you get above trend. And again, I wouldn't argue, that means the world is going into some difference. I think I just want to be either the brilliant guy or the complete idiot. But either way, that 1% trend is here, and it seems to be pretty sticky, and it survived global communism. It survived, many different panics and crises and all kinds of stuff. And so I think I'll stick with that and think it's extremely likely to continue. And I guess just one last point on that. So my friend Arjun Murthy has put out these analyses on sort of potential total demand for oil if everyone was sort of as wealthy or lived in a certain way. And so if you look at not American oil consumption, because Americans, we use a lot of oil relative to everyone else, but if you look at Western European, which is way sort of more frugal in terms of oil consumption, and you look at the per capita oil consumption in Western Europe and you apply that globally, you get something like 250 to 300 million barrels a day of global oil and liquids demand. And so, yeah, electric vehicles cut into that, certain other things cut into that, efficiencies cut into that, but it's such a large number that you're still going to get that 1% probably for a very long time. So anyway, that's the long answer to the short question, but that's, I think, understanding that framework makes the sort of, oh, but electric vehicles or but whatever sort of objections, I think it puts them in context. And I think those are best understood as why you're not seeing 4% or 3% annual demand growth for oil, why you're only seeing 1%.
Yeah, you mentioned that that calculation, Western Europe, if everyone were to adapt that living standard, oil, natural gas wise, 250 to 300 million barrels a day, that's compared to just a bit more than 100 million barrels a day today, right?
Yeah, that's right. Yeah.
Awesome. All right. Thank you for putting it into context. Talking about natural gas for a second, is there any reason to believe the thesis over there is any different?
Yeah, so natural gas is, I'm also bullish natural gas, which is sort of new-ish for me. I was not very bullish gas for a while. So it's a different dynamic because the demand growth for natural gas is much higher. And some of it is structural, where it's just you can use natural gas for power generation and directly for heat, and it's very clean burning. And so there's been various reasons for people to prefer using it. And then also in North America, it's been extremely cheap. And so it's competed very effectively, even economically, with coal. And then also, on the full cost, if you include storage costs and so on, it's cheaper than alternatives, which I know a lot of people will complain about that. But again, if you include the reliability cost on alternatives, it is substantially cheaper. And so the economics of it, because it's been such a low price, plus the utility of it being useful both for power generation and for direct heat provision, and also its usefulness in chemicals and various other sort of similar processes, has allowed it to grow. Demand for natural gas has grown by closer to 3 or 4% a year versus the sort of 1% or a year or so demand growth for oil. So it's I know it doesn't sound like a lot of demand growth considering sort of some of the crazy demand numbers for AI where you're doubling the GPUs every 6 months or whatever, but that's pretty substantial. And then there is this carryover with the AI stuff, which who knows how long that trend will continue. Perhaps it will go for a while, and these big bets by the Mag 7 companies and the wealthiest people in the world, who in many cases are self-made multi-billionaires or more, and they're heavily betting on it. Maybe they're right and maybe they're wrong, but either way, it seems like the orders that they're putting in right now to buy all of these chips and then put them into these giant data centers are going to put demand so far on the current trajectory. And again, I don't know what the future will hold for this, and it could go both ways, but the current orders seem to be way ahead of people's forecasts. And so we could actually see an additional multiple BCF a day of demand for natural gas by 2030 for these data centers in a market that's actually potentially already going to be undersupplied. And so we're at roughly 107 BCF a day right now of supply, depending on the source, maybe 106, maybe 108. And we're rapidly growing LNG export facilities, which are sort of the main incremental source of demand beyond just the sort of structural 1 or 2% growth in electricity demand outside of data centers. And so we already needed to grow roughly another 50 to 20 BCF a day of production just to supply these LNG facilities that are getting built and that are funded and in some cases are already in construction. And then there's now this sort of upside surprise case on the data centers. And so we'll see. Again, I'm not the world's expert in data centers, but I can see what the orders are and I can see what the demand is that's coming in. And then I think the big shift there is, one, it's way bigger than people expected, and two, it's getting powered much more by natural gas many of them have these narratives. Oh, in 10 years, we're going to have these SMRs, the small modular reactors for nuclear, or, oh, hey, we're going to use solar and wind and whatever. And then you look at it, and it turns out that they're really mostly just powered by natural gas, and especially the ones that are hooked up to the grid, where they're hooked up to the grid, and then they have giant natural gas power generation in the background. And then just one note on that: outside of the U.S., we're starting to see more and more of that backup being done with diesel power generation and other sort of heating oil and fuel oil type complex. And in some cases, I think propane and certain other NGLs being used for that backup power gen too. And so there is this sort of, everyone knows about the upside scenario for natural gas demand from data centers, but there's actually weirdly a scenario of upside demand for oil, which could completely shock the world, right? I mean, I don't think anyone's expecting an incremental barrel of, maybe for the construction, but not for the powering of these facilities. But you look in Europe and Asia, and there are places where the price for natural gas is quite high. And with oil in the low 60s and natural gas on a fuel equivalent basis actually pretty similar, especially in places with CO2 taxes and other sorts of concerns, you could pretty easily see a substantial amount of oil burned for these data centers. But anyway, back to gas. I think there's this extra sort of upside surprise baked in, and the supply, I think, is going to be, there is supply available, but it probably needs... It gets back to the question of, if you need it right now, the price could be radically higher. And if you need it in 5 years or 10 years, maybe you could get it at sort of that lower price. And so as demand gets pulled forward, it makes me think that natural gas prices could go higher and then potentially stay higher than people are expecting over a multi-year period.
Awesome. Thank you, George. I would love to talk about producers of oil and gas in just a second. But of course, in the US, talking about natural gas for a second, of course, most producers produce both natural gas and oil. However, there's still basins in North America where natural gas tends to go negative, if I'm correct, over time, a couple of days a year. Is that an interesting place to be looking at these producers?
Yeah. I like, it's sort of a complicated question because you would not think that people would be giving away natural gas in this very likely to be very tight market for years. And so it's sort of this weird thing where the wave is coming of demand, but it hasn't quite arrived yet, both for the LNG facilities and for the data centers, this incremental demand. And so you're in this weird spot where it's coming, and people are actually ramping up drilling for gas, even though the spot price fell close to $3 an MCF, or I think even a little below that for brief periods, the hub sort of general spot price. And then you still had people actually ramping up their drilling for dry gas, which felt very weird. It makes sense, but it felt very weird. So yes, I think the places where you get negative gas, so you had negative gas at ACO and Station 2, so up in the Western Canadian hubs, and then you had it also at Waha in West Texas, Southeast New Mexico. And so the only problem with that thesis is that I got really excited in 2020 when prices went negative and people said, oh, it's going to stay negative for a while. It's like, I will buy heavily like that. It's a great bet. And it worked. But then we got back into an oversupply situation in the Permian and prices went negative again, similar in Western Canada. So I do think that over time, there's going to be extra infrastructure and extra demand for the gas in the areas where there's been negative prices, because you can't count on that in the future, but there's a decent shot of it. And then you can also hedge the gas. So as a demand center, whether you're a data center or LNG facility or just a trader, you could in theory lock in lower prices in West Texas right now than you can in other parts of the country. I think you can, I was looking at a quote yesterday actually, and you could get actually almost a $1.50 discount from NYMEX if you were buying it in West Texas. So pretty significant. If you're looking at like a $4.50 forward price 1 year out, you could buy gas for around $3 or so local. So which is weirdly just around the current price, but that's a huge discount on a percent basis versus the NYMEX price or what you might have to pay in here in Texas and Houston, or up in the Northeast or so on. So yes, I think it's really interesting to get that exposure, but it's also very, very complicated. And I've also both gotten this bet right and wrong. So I'd just emphasize caution.
Talking geopolitics for a second, OPEC Plus, is their power slowly dwindling over time?
It's a great question. I think their power is actually increasing. I'm just not sure that they're doing a good job of navigating it. And so I think if they worried less about media reports in which some of their members appear to be leaking what they're talking about ahead of their meetings, and worried more about the game theoretics to optimize around maintaining a tight oil market over time while also ensuring adequate supplies to avoid a super spike, that they would be much better served and better accomplish their goals. So doing a bad job with PR doesn't necessarily mean that you're losing your ability to control the market. It just means you're doing a bad job with PR. So that would be sort of I think when you look at the percent of global oil production for OPEC, it's right now at a multi-year high, and they're in a very good position to affect the oil market if they chose to. And then the strategy they're employing, if you take away the PR, where they appear to be ramping their production temporarily, partly just to test what the true demand is for oil, as well as to, it looks like, reset the quota levels for the various OPEC and OPEC Plus member countries, because there are some countries that claim spare capacity levels that are quite high, others that don't, some that were cheating, like the Kazakhstans of the world, but cheating because of legacy investment where they're now in decline. And where I don't even know that it was so reasonable for anyone to expect Kazakhstan to produce any less than they did, right? You spend $100 billion on 2 giant offshore facilities. I mean, of course you're going to produce from it. There's just enormous financial pressures to produce from it. But then you might not reinvest more into growing production for a very long time, and you sort of go into slow decline. So I think there's a lot of different things they're balancing. I think overall as a strategy, it's been effective, and I think we're going to see more proof of that. I think next year there's a good chance they actually cut after they've sort of brought production as high as they can, as they've shown that, like, Russia, for example, can't deliver as much production as they claim, as they show several other countries can't grow, and as they sort of embarrass some of these countries that were cheating by raising their quotas above the amount they were cheating by, and show that they can't actually produce more than the amount that they were producing, like the Kazakhstans of the world. And so anyway, I think they're in a very good position. I can't say they've done a great job with it so far. I think it'll look a lot better for them a year from now, as they, I think, go from sort of dealing with some of their internal issues and resetting production quotas and so on, while also solidifying their position as the swing capacity, which I think sometimes in order to do that, you have to actually show you can deliver that oil, and then also test the true demand for your oil before you pull back and show proven spare capacity for a circumstance in the future where it might be needed.
If you don't use it, you lose it type of thing. Conflict seems to be on the rise, globally speaking. I mean, recently we saw Iran and US go at it. Of course, Iran, Strait of Hormuz, 20% of the oil, I believe, goes through that daily. Is there a rise in the risk of disruptions in the oil supply?
Yes. It's actually sort of weird how much oil is on the market right now from places that have been off or had more of their oil off the market over the last, let's say, 20 years. And so I think that's actually one of the reasons, if you look at sort of U.S. drilling activity and you look at global activity and you look at what OPEC's doing and so on, the thing that I think that best explains why WTI oil is at $61 and not $81 is you have Libya at nearly decade highs, or maybe I think actually at decade highs. You have Iran exporting more oil than they've exported in more than a decade. You have certain other spots that are producing more than you would have thought. And so those aren't really driven by OPEC dynamics. Even if they're OPEC members, they're considered exempt because they've had sanctions or other sorts of issues. Libya had a horrible civil war, which seems to pop up. Unfortunately, that conflict's not fully over. And so the way I think about it is that there's going to be some range of sort of geopolitical disruption of oil. And there's certain oil that's at supply risk or disruption risk. And right now we're at a very low point in terms of disrupted oil. And I think it's reasonable to expect with some variance that you're going to get back to an average point of disrupted oil. And is that going to be another 1 million barrels a day or 2 million barrels a day? I don't know, we'll see. But somewhere in that range, I think, would be more reasonable given what we've experienced over the last 20 years. It certainly doesn't seem, despite our glorious leaders' recent, at least here in the U.S., recent social media posts and so on, unfortunately, peace for all mankind has not been achieved. And so it does seem unlikely in today's unstable environment that the current almost Pollyanna-ish or Goldilocks type scenario of very low oil disruptions will continue. So I would expect more, one spot where you could see some oil come off would be Russia, where so far Russian oil exports are actually up because the refineries have been attacked by Ukraine, and some of the oil that would have been refined and consumed domestically or refined and then the refined products would have been exported is now being directly exported. There are limits to that. It seems like they're getting close to that limit. And as Ukraine continues to strike Russian refineries, which seems to be a trend, hopefully there's peace, but unfortunately it seems like that's not anywhere likely for the near term. As Ukraine continues to strike Russian refineries, it's increasingly likely that there's going to be Russian oil and refined products that come off the global market. And the more of these attacks and the bigger they are, the bigger that could be. And so I think you're setting up for a potential disruption in the tune of 500,000 to 1 million barrels a day, which would basically just get you back to the average level of oil supply disruptions for the last 20 years. So sort of, I think it's less about that's one example. It's less about any one individual country and more about sort of looking at this basket of at-risk supply and figuring that across that basket, there's going to be at least one or two issues at any given time, and that it's extremely unlikely that the current situation that we've experienced in the last year or so with increasing supplies from Iran, from Libya, from actually even Russia recently, they seem very unlikely to continue.
Well understood. Where should oil prices be, taking all this into account, the demand, the supply, the geopolitical risk?
Yeah, I think the price should probably be, like WTI should probably be around 80 or so right now. And I think we end up with much higher prices, but we also may end up, and this is sort of the strategist speak for I don't know, we may end up with temporarily lower prices Q4 this year and Q1 next year, because under almost all circumstances, there are going to be global oil inventory increases. And so we haven't had them yet, but it's increasingly likely they'll happen. The sort of doomsayers or doom forecasters think we might get as high as 4 million barrels a day of global inventory increases, right? You look at some of the cases from the IEA, some of the different investment bank reports, some of the commodity trading houses and so on. They have extremely large builds forecast. Some of the oil traders and some of the folks I know who actually have to make a living on this think it'll be closer to, let's say, 1 million barrels a day or so of inventory increases. And so there is some risk that even though it's very likely that we get into meaningful undersupply, sort of deep cyclical or arguably even structural undersupply for oil later next year, it's possible that the oil market won't look through that, and it's possible that we could end up with a short-term period of lower prices. But again, I would argue we're already experiencing that here in the low 60s for WTI, and the forward curve has us going into the high 50s. And so the current forward curve, I think, is already heavily discounting what's likely to be oil inventory increases. And one of the exciting parts about it for me, owning oil and gas equities and being sort of pretty bullish on oil, is that when you have these ultra low expectations, you have all of these negative things essentially priced in and well known, if the oil traders I know, the physical guys I know who are expecting 1 million a day of builds are right, you could actually see oil up another $10 or so, sort of similar to how OPEC increased production, but they increased less than had been leaked. And you saw oil prices rise rather than fall. It's such a weird, interesting thing if you think about it. OPEC increasing their production quotas and the price rising and not falling. I think you could have a similar thing with these inventory builds, but there's also a risk, of course, that if you have inventory builds, even with a discounted price, the price could fall a little more but before it rebounds.
Thank you for starting to talk about oil and gas equities for a second. I would love to talk about where you are finding the most bargains right now.
Sure. Yeah. So I actually launched this newsletter recently, which is sort of fun. My day job is to run an oil and gas equity investment fund and strategy that I advise. And, as a part of that, I find lots of different oil and gas stocks that obviously I'm investing in, or most I'm choosing not to invest in. And launching a newsletter is helpful because I could basically take some of my favorite ideas and write about them in sort of a structured, regular format that's sort of compliant, and also just it's really fun to get to share specific ideas one at a time, with sharing the full investment thesis and sort of what I'm seeing. And there's really not a lot of options for people to go to as far as I can tell. I mean, I'm an avid reader of these things, and it's very hard to find something equivalent to this. So I would say from a category perspective, large cap oil and gas stocks, particularly the major integrateds, are very expensive here. And the performance has actually not been that much worse for them than the broader stock market, even though their earnings are quite low and their reinvestment rates are quite high. And so, to me, those are not that exciting. Other than that, they're really promising, I think, for some of the other oil equities, because, hey, if you can take these companies and they have worse margins than they used to, worse returns on invested capital, complicated strategies, bad governance, and they still trade at pretty high multiples and they've traded well versus the market, I think there's a lot of upside for some of these other sectors. And you've seen refiners also trade up well on, I think, stronger fundamentals and lower valuations. And so the areas that I'm most excited about are small cap producers, but certain ones where I think there's a lot of risk and volatility. And again, that's sort of where I've tilted more towards the newsletter format rather than just sort of ad hoc sharing random ideas, because I think really understanding the investment theses and the risks that come with them, where these things are very volatile. And there's one stock I talked about on TV in 2020. It was 20 cents a share, and I was buying the stock right then. I didn't think anyone would buy it. It was a crazy idea, just very, very levered to the price of oil. And so I talked about it, like tripled while I was on TV talking about it. And then it went up from 20 cents when I talked about it to a peak of $5 over the next 18 months. And then it went to zero. And so, so there's lots of volatility. You can get a 25 bagger and a zero, and it's the same stock. So, that to me was a good lesson to try to be much more structured in sort of how I share these ideas, as well as the potential upside and downside from some of these things. So I think there's a really rich universe of some of these small cap producers. And then also on the services side, where the services underinvestment's actually been even more than the upstream underinvestment. And so the companies that have survived are truly impressive. You meet these executives, even like the worst services companies that are around are some of the best from a decade ago, because the things they needed to do to survive, the incredible operating performance and financial management and people management that was necessary for these companies to make it through this very, very long downturn is really impressive. And so there's a number of these services companies. Honestly, most of them I think are great because of those characteristics just necessary for them to survive. But there are some of them that are truly extraordinary. And the part about it that's so exciting to me, maybe even more exciting than the producers, is that because of the big underinvestment and because of the nature of some of these businesses where they own equipment and they trade at a tiny fraction of the replacement value or liquidation value of the equipment, there's room to buy these things at, let's say, 20% or 30% or 10% of the replacement cost, and maybe 50% of the liquidation value of their rigs or pressure pumping equipment or various other equipment. And so to me, it's exciting because I can buy these things that are well run, because all the ones that aren't well run, for the most part, are out of business. And then they're at a big discount to replacement cost. And then also, in many cases, they actually earn a lot of money, at least relative to their current market caps and enterprise values. And people think, hey, services is not a great place to be because it did so poorly, but it did poorly from very high valuations at a very bad part of the market, so part of the cycle for those companies. The circumstances right now are inverted. The valuations are very low. Activity levels are very low. The competitiveness is actually very low. There's very few of these companies left, relatively speaking. And the market dynamics are much better, where the providers are much more concentrated. There's way fewer competitors, and it's just a much more rational and profitable environment. And so the idea, I say all that to say, basically, I'm buying stocks at like a fifth of replacement cost at 20% free cash flow yields. And those two things should not exist in concert at that moment. And I'm buying them today, and some of them I've written about for this newsletter. So again, it's not really about the specific name or whatever. It's this opportunity set that really just should not exist. And historically, you either get a big discount to replacement cost, or you get a low valuation on a cash flow multiple. You almost never get both of those. And so that, to me, it may be my favorite thing in the whole commodity complex, is these services companies at giant discounts to replacement cost at really high free cash flow yields. And in some cases, they, like you said, they pay you a dividend, or they're paying down debt and buying back stock and so on. So really, really nice. They're not painful to hold, and they're just these tremendous values where you just sit on them for a long time potentially and earn really high compounded potential returns.
Thank you for putting that on our radar. Definitely going to have to put in some elbow grease and look at that opportunity. Sounds very exciting. I would love to make a parallel to the broader commodity complex for a second, because what we were talking about with the underinvestment in oil and gas, that seems to be the same for the entire commodity industry.
Yeah, I mean, it's so interesting. I feel like, so we just put out this white paper for the fund, and we looked at the junior miners, the junior gold miners. And, you know, anyone listening to this is going to know junior gold miners have gone crazy, right? They went from an area that people considered uninvestable. They might still consider it uninvestable, I'm not sure. But the performance went from way below the broader stock market to far exceeding the broader stock market over the last 10 years. And so if you look at what people said about gold miners 2 years ago in terms of, oh, they're bad investments because of X, Y, and Z factors, these are very similar, and in some cases the same, as the critiques of oil and gas producers and services companies. So the pushback is almost exactly the same. It's from almost exactly the same people, or, you know, in some cases, sort of people that feel even stronger about it. You know, the gold mine, there's something sort of in our human nature where that's always going to be at least a little appealing. The, you know, dirty like oil field or whatever is something that people find unappealing, I think, intuitively, versus a gold mine where everyone, you know, it's an aphorism, the, you know, something being, you know, money printing as, you know, gold mining. So I think you look at the dynamic there where you had intense hatred, severe pushbacks that in many cases were completely divorced from the fundamentals, and then phenomenal performance. And you basically have a small number of people that stuck through it, that were able to figure out that the economics were compelling. Again, it's sort of that meme of like the brilliant people and the people that just held their shares from the last bull market or whatever. And you ended up with this incredible compounded performance over a decade, all earned in the last 6 months, year, whatever, as it became clear that there was an undersupply of gold, and frankly, an undersupply of gold miner shares. And so we're seeing this now carry over into certain other commodities and other markets. You saw the other precious metals. You're starting to see silver rise, and the miners there rise. You're starting to see copper miners do quite well, and certain other aspects in this broader sort of commodity complex. And so, first of all, as these guys issue shares to go build their mines or expand their mines, energy is going to be a significant portion of where that money goes. They're going to go buy diesel, they're going to go buy various other things that are very energy intensive, and they're going to use it to build and expand these mines. So directly, there's an incremental sort of set of demand that's going to come, that mostly hasn't come yet, from this move that's already happened in commodities. So that's one reason I think for commodity investors to be particularly interested in oil here is what they've seen already and what they're currently actively funding in gold and in various other precious metals, and now in certain other commodities, is actually driving incremental demand for oil. But then also there's just this historic price relationship, maybe because of oil fundamental demand in mining, and maybe just because when you get increased interest in gold and in these other commodities, you end up having speculative interest follow in oil. And so it's both this historical demand as well as the historical technicals. You look at the combination, and I think it's a really, really compelling setup. I think sort of similar to maybe what some of the other commodities looked like earlier this year. We had the gold move, and then you had sort of these echo moves in copper and silver. I think it's very easy to see that oil could come soon, both again from the incremental demand and because historically, not in all cases, but in most cases, when you saw this sort of move in gold and this sort of move in certain other commodities, you almost always saw oil prices go from relatively low levels to levels that people think are ridiculous. Like, imagine rewinding 2 years and telling someone, hey, gold is going to go to $4,000 an ounce. They would just think you were an absolute lunatic. But you tell someone, hey, oil prices are going to double from here, and today they will think you are truly a lunatic. And I don't know, it seems very, very similar, again, fundamentally, as well as just looking at prior historical price patterns.
Yeah, it's a really, really interesting comparison. Just it seems so obvious that there's a significant underinvestment in the commodity complex, and therefore we're all contrarians looking at the space, and that's the side of the trade you want to be on.
Yeah, you would think so, but it is just so interesting. It's been, I think, I don't know about the actual oil demand. Let's say, I mean, there's lots of incremental demand from the share issuance, but you look at the sort of morale aspect of watching these different commodities move. And, again, social media is great. One of the ways it's great is you can track how people hate certain things and what they say about it. And so if you look at the narrative around, let's say, silver earlier this year, and you had people that were bullish silver for fundamentals and because gold had already moved, and you saw the pushback on it, and then you compare those to the negative perspectives on oil here, both fundamentally and from a price perspective, and they're so similar. And so again, this time could be different. Past performance does not guarantee future results, but hey, history may not repeat, but it rhymes, and it looks very promising. And again, as someone who has this longer term perspective on the commodities, seeing and on oil in particular, seeing the same sort of thesis play out in other commodities, I think makes it promising, at least for me, that there will be potentially similar performance for oil.
And Josh, you mentioned off camera that you're a secret closet precious metals bull as well. Perhaps you can talk about really what your long-term view on that material is.
Sure. Well, I don't know if it's that much of a secret. There was I posted something on social media like 18 months ago. I went to Costco with my dad, and he's been a precious metals bull since before I was alive. So we went to Costco, and they had a sign at the front talking about how they had gold coins, and I think it was like just under $2,000 an ounce. And so I started doing some math in my head because I have the executive Costco membership and the credit card. And so the membership gives you a 2% rebate, and then the credit card gives you another 2% off. And the price they quoted, I was like, as we were walking through the store, I was like checking on my phone what the spot price was and I was going to get to buy gold at like a 3% net effective discount to the spot price. And so I was already pretty bullish gold just because of what was happening. There was this enormous fiscal deficit here in the US. You could see what was happening globally. And so I was a happy personal buyer, not in giant size, of gold at a discount to spot. And then on future Costco trips, I may have also indulged in this speculative endeavor. Honestly, I don't know what I'd do with it. I keep it in a safe deposit box, so it's, somewhere that, hopefully where it won't go anywhere. But, it makes a lot of sense to me that it would have moved. And a lot of fundamental value investors look at gold and say, hey, there's no cash flow from it. And that's true, but for thousands of years, gold has held its value while various countries have done what the US is doing and other governments are doing where they've debased their currencies. And so, to me, it makes a lot of sense that the price for gold would do what it's done historically over a very long time frame, which is just that it would preserve its essentially purchasing power denominated in gold. And so I don't know that I'm a gold bug in the sense that I think that gold is going to go to an infinite price. But it did make sense to me to get some exposure, especially I'm very cheap to buy it at a large discount, versus in the prior gold bull market. I think I remember seeing gold was up to, in some cases, a 10 or 20% premium if you were buying certain gold coins or so on, in that sort of 2012 sort of gold coin mania. So getting to buy it at a discount was pretty exciting. So I get it, and I think the interesting part here is that it's worked, right? And so purchasing power has been preserved in gold relative to the huge amount of inflation. Even if you don't believe CPI, even if you think, hey, I'll measure actual prices of things I buy, like my restaurant bills and the food I buy and the various the services I pay for. And so when you look at that, and then you look at the oil thesis, and you look at how gold and oil have actually traded pretty closely over a very long time, and you denominate your oil in gold, and you say, hey, this oil looks a lot too cheap. And oil also is driven, not as directly, but it's also driven by fiscal profligacy, and it's also driven by currency devaluation. And so I think even if I took my supply-demand hat off for a second for oil and just looked at it purely from a generalist, commodity perspective, I think there's an argument there for essentially oil as black gold, and it looks pretty interesting there too. But yeah, I get it, and I actually think the one controversial thing I could say about metals, and again, this is not my expertise. Please, no one go bet on this because I'm saying this, but it does look like silver has this potential to super spike here, and why would it do that? I mean, it's already up, but if you look historically, there's been these similar price relationships between gold and silver and gold and oil, where you have gold go up, and then you've had this tendency, whether it's that the gold coins or bars are too expensive, so people just go and speculate on the silver ones, or whether it's because people get more bullish on the broader prospects for the economy, and so they still want the protection that they get from precious metals versus debasement, but they want to have sort of a more pro-cyclical bet. Those things are true for both silver and for oil. And again, I don't know the supply-demand balances for silver. I have a tiny options bet on silver and silver miners, but as sort of full disclosure. But I think you could see both silver go crazy and move in a way similar to what it did in prior cycles. And I think we're likely to see oil do the same. And incidentally, the higher these metals go, I mean, I'm a huge metals fan as an oil bull, because the higher the metals go, the more likely it is that we end up with substantial incremental mining related demand. I mean, the numbers start to get ridiculous. And again, as the numbers on new development get ridiculous for a commodity, I think it makes sense to get more cautious, which I think I am on gold here. I don't know where it goes, but the fundamental case for it, I think, is a little more challenged. The fundamental case and the technical case, I think, for silver and for oil and certain other commodities looks great here. And the supply-demand balances for oil, due to the underinvestment over a long time, look extremely compelling here.
George, I would love to hear a bit more about your Substack. How can people find that and learn more from you?
Sure. Yeah. So, like I said, I launched this Bison Insights, we're calling it. So at bisoninsights.info. And, it's I think, a relatively modest subscription amount. We're not trying to like rip anyone off or whatever, mostly just using that to fund the research effort. And, I'm sharing one idea a month approximately. Started out a little faster than that and gonna sort of keep it at around one a month. And at least for right now, there's so many different ideas. The challenge isn't, hey, can I find one thing that I think could massively outperform and that I'm really excited about and that I own? It's which thing do I talk about, because there's so many that are just so compelling here. And so, it's been really fun to build. There's actually been a lot of uptake. So I'm really happy that a number of people have subscribed already. And I guess for Substack, it's sort of one of the top sellers or whatever. So that's great. And I think it'd be really wonderful to have even more people sign up. And I think it's one of those weird things where what's normally available to people in terms of investment research or stock ideas or even people sharing their processes in so many cases is so problematic. And so it's also nice. You see all these different pump and dumps and sort of weird things going on in the market and promoters and so on. And so I think it's nice to be able to share. I've done this for a very long time. I've been running this investment strategy that I'm running now for more than a decade. And so it's nice to be able to share some interesting ideas and also be very upfront about the various risks and concerns so people can learn something. And anyway, that's what I'm up to. And so far it's been so fun. I didn't realize, I like writing about stuff. I like sharing ideas, and it's really, I think it's been way more rewarding than I expected to share ideas. And some of them have already worked out really well, and others are still in process. And hopefully additional ideas I share. Again, past performance is not indicative, but so far so good. And it's been fun to do. I think people have enjoyed getting to read it and getting a little more insight into what I'm doing specifically. And it's a nice sort of mechanism for sharing ideas in a structured way to people that are interested in learning about them. And so, it's been a very constructive experience, and I'm excited to write a lot more on there.
For anyone interested, link will be in the description. George, thank you so much for your generosity with your time and your insights today. Really appreciate it.
Yeah, thanks so much for having me on. And, I'm an avid listener to your guys' channel and listen to a number of my favorite people to listen to that you've interviewed somewhat recently. So it's fun to get to be on this. Thanks for having me.
Awesome. Really appreciate that, George. This podcast is for general information purposes only and does not constitute investment advice, an offer, or solicitation to buy or sell any securities. The views expressed are those of the host and guest and do not necessarily reflect the views of the company or their affiliates. Guests on the show are not compensated for their appearance. Certain discussions may include forward-looking statements subject to known and unknown risks and uncertainties that could cause actual results to differ materially. Listeners should do their own research, consult a licensed financial advisor, and not base any investment decisions solely on the information discussed. For a full disclaimer, please visit our website, and for full disclosure and risk factors of any companies referenced, please see full available disclosure and risk factors on their CEDAR Plus at www.cedarplus.ca.